October 24th, 1929. The marble lobby of the New York Stock Exchange smelled different that morning. Not the usual blend of cigar smoke and leather briefcases and expensive cologne. Something sharper, something animal. Fear has a scent, and by mid-morning on Black Thursday, it was everywhere. Thomas Ashford had been a runner for J.P. Morgan & Co. for 3 years. At 22, he'd seen fortunes made in minutes, watched men become millionaires before lunch, witnessed the kind of wealth creation that made America feel invincible. The Roaring Twenties had been the only adult life he'd ever known. Prosperity wasn't a phase, it was reality. But when he pushed through the brass doors at 9:47 that morning, carrying a leather satchel full of sell orders, he noticed something he'd never seen before. Silence. Not complete silence. The trading floor was never truly quiet, but the quality of sound had changed. The usual bravado, the back-slapping jokes, the confident shouts of "buy" echoing across the floor, had evaporated. In its place, whispers, urgent, clipped conversations, men clutching telephones with white knuckles, the ticker-tape machine chattering like an insect trapped in a jar. Ashford approached the tape. It was already running 45 minutes behind real-time trades. By 10 a.m., it would lag 90 minutes. The machinery of American capitalism, the very infrastructure that made the boom possible, was drowning in its own success, or drowning in something else entirely. Near the Morgan desk, a senior partner named Edward Simmons sat motionless, staring at a telegram. Simmons had made a fortune in railroad stocks. He drove a Packard. He owned a summer house in the Hamptons. He'd spent the last 5 years telling anyone who'd listen that America had entered a new era, that the old rules of boom and bust no longer applied, that scientific management and mass production had created a perpetual prosperity machine. The telegram in his hands was from his broker. Margin call effective immediately. Liquidate all positions by close. No extensions available. Simmons looked up. His face had gone grey. This wasn't supposed to be possible, he said to no one in particular. Ashford didn't understand yet, but he felt it. That morning, something fundamental had broken. Not just stock prices, something deeper. The confidence that had powered the entire decade, the belief that America had transcended the old cycles of history, was cracking like ice on a frozen pond. By noon, the cracks would become chasms. By nightfall, the entire system would be underwater. 11:15 a.m. The street outside. Broad Street was no longer passable. Thousands of people crowded the narrow canyon between buildings, necks craned toward the exchange's windows, as if they could see their futures evaporating in real time. Police officers formed human chains to keep the crowd from surging forward. Mounted officers circled the periphery. Somewhere in the mass of bodies, a woman fainted. No one helped her. Everyone was fixated on the building, on the numbers, on the lie they were only now beginning to see. Inside brokerage houses up and down the street, scenes that would have been unthinkable 24 hours earlier were playing out in real time. At E.F. Hutton, a broker named Robert Crane was on his 17th phone call of the morning. Every call was the same. A client. Men he'd personally assured that stocks only go up, that margin loans were safe, that the new era was real, demanding to know why their accounts were being liquidated. "I put in $20,000, one client shouted through the phone. "You're telling me it's gone, all of it?" Crane wanted to explain about margin calls, about how loans had to be paid back, about how when you buy stocks with borrowed money at 10-to-1 leverage, a 10% drop doesn't just erase your gains, it obliterates your entire position. But he couldn't find the words, because he was in the same position as his clients. He'd believed the lie, too. 12:30 p.m., the moment of realization. In a private office on the 7th floor of 23 Wall Street, 6 men sat around a mahogany table that had witnessed the creation of U.S. Steel, the financing of World War I, the orchestration of deals that had reshaped the American economy. These were not ordinary men. They were the men. The senior partners of the most powerful banks in America, J.P. Morgan Jr., Charles Mitchell of National City Bank, Albert Wiggin of Chase National, Thomas Lamont, Morgan's right hand. They'd called an emergency meeting to stop the panic, to inject confidence, to do what they'd always done, stabilize the market through sheer force of capital and reputation. But as they reviewed the numbers, the volume, the margin calls, the credit exposure, something shifted in the room. Lamont spoke first, his voice steady but hollow. "Gentlemen, we need to be clear about what we're looking at. This isn't a liquidity crisis. This is a solvency crisis. The margin debt is larger than we calculated, significantly larger." Mitchell leaned forward. "How much larger?" "Our best estimate? $8 to $9 billion in outstanding margin loans, against a market that's lost $20 billion in value this week." The silence that followed was absolute. $9 billion, borrowed money, owed immediately, secured by stocks that were plummeting in value by the hour. Wiggin, normally unflappable, set down his pen. "We can't backstop that." "No," Lamont agreed. "We can't." The men in that room controlled more capital than most nations. They'd believed, truly believed, that their power was sufficient to manage any crisis, that their understanding of markets, their access to information, their ability to move billions of dollars with a phone call made them immune to the kind of catastrophic collapse that had destroyed less sophisticated economies. They were discovering, in real time, that they'd been wrong. Not just wrong about the magnitude of the crisis, wrong about everything. The prosperity they'd overseen, the wealth they'd created, the new era they'd proclaimed, it had all been built on leverage, on borrowed money, on the assumption that prices would always rise, that credit would always be available, that the machinery of American finance was too sophisticated, too modern, too scientific to fail. But sitting in that room, staring at numbers that didn't lie, they understood. The Roaring Twenties had never been real. It had been a mirage, a beautiful, seductive, universally believed mirage. And on October 24th, 1929, the desert sun had risen, and Wall Street was discovering there had never been any water at all. To understand how the lie took hold, you have to go back to 1922. World War I was over. America had emerged as the world's creditor nation. European powers owed the US billions. Gold flowed into American vaults. Industrial capacity, built up during the war, was now retooled for consumer goods, radios, automobiles, refrigerators, washing machines. For the first time in human history, ordinary Americans could buy, on credit, machines that transformed daily life. This felt like progress. It felt like prosperity. And in many ways, it was. But underneath the genuine innovation, the assembly lines, the electrification, the mass production, a different story was unfolding. One that almost no one understood until it was too late. The seduction of the new era. By 1925, a narrative had solidified in American culture. The old rules no longer applied. Economists wrote papers about perpetual prosperity. Business magazines published articles explaining why boom and bust cycles were obsolete. Radio personalities assured listeners that stock market investing was no longer speculation. It was scientific wealth accumulation. The logic was intoxicating. America had mass production, electrification, modern management techniques. Productivity was soaring. Corporate profits were rising. Why wouldn't stock prices rise forever? John J. Raskob, a General Motors executive, published an article in Ladies' Home Journal titled, "Everybody Ought to Be Rich." He calculated that anyone who invested $15 a month in stocks would be worth $80,000 in 20 years. The article went viral. By 1929, everyone from shoeshine boys to college professors was playing the market, but what almost no one understood was how the game actually worked. The explosive device, margin loans. If the Roaring Twenties were a building, margin loans were the termites in the foundation. Here's how it worked. Say you wanted to buy 100 shares of Radio Corporation of America, RCA, at $100 per share. Total cost, $10,000. But you didn't have $10,000? No problem. Your broker would lend you $9,000. You'd put up $1,000 of your own money. The stock itself would serve as collateral. This is called buying on margin. If RCA went up to $110, you could sell, pay back the loan, and walk away with a $1,000 profit, a 100% return on your initial investment. But if RCA dropped to $90, you'd get a margin call. Your broker would demand you either deposit more cash or sell the stock immediately. If you couldn't pay, the broker would liquidate your position, you'd lose your entire $1,000, and you'd still owe the broker $1,000 to cover the shortfall. This system worked beautifully in a rising market. It was a death spiral in a falling one. By 1929, margin debt had reached unprecedented levels. Estimates vary, but the most reliable figures suggest $8 to $9 billion in outstanding margin loans, roughly equivalent to half the total value of the stock market. Think about that ratio. Half the market was borrowed money. Worse, the leverage ratios were insane. Some brokers allowed 20 to 1 leverage. A few allowed 50 to 1. You could control $50,000 in stocks with $1,000 of your own money. It was a bomb waiting for a spark. The gold standard trap. But margin debt was only part of the story. The other part, the part that made catastrophe inevitable, was the gold standard. In the 1920s, the US dollar was backed by gold. Every dollar in circulation was theoretically redeemable for a fixed amount of gold. This was supposed to ensure stability. Instead, it created a rigid, brittle system that would amplify the crash beyond anyone's nightmares. The mechanism was elegant in its simplicity and devastating in its consequences. When stock prices started falling in September 1929, foreign investors got nervous. British banks, French investors, German institutions, they all began pulling money out of US markets and converting dollars to gold. Gold started flowing out of American vaults at an alarming rate. Under the gold standard, when gold leaves the country, the Federal Reserve faces a terrible choice: raise interest rates to attract gold back, or watch the entire monetary system collapse. Higher interest rates make US investments more attractive to foreign capital. They also make borrowing more expensive, which slows economic activity, which reduces demand for credit, which, in theory, stabilizes the currency and stops the gold outflow. In a normal economy, this might work. But in 1929, America wasn't running a normal economy. It was running a leveraged casino disguised as a market. Raising interest rates didn't stabilize the system. It detonated it. Remember, margin loans were callable on demand. When interest rates rose, brokers demanded immediate repayment. Not next week, not next month, now. Investors who'd borrowed to buy stocks were suddenly forced to come up with cash they didn't have. The only way to get cash was to sell stocks. But when everyone sells simultaneously, prices collapse. Forced selling pushed prices down. Lower prices triggered more margin calls. More margin calls forced more selling. Lower prices meant investors' collateral was worth less, which meant they had to sell even more stock to cover the same debt. It was a feedback loop, a death spiral, a systemic design flaw baked into the very architecture of American finance. The gold standard, sold to Americans as a guarantor of stability, a protection against inflation, a sign of fiscal responsibility, had become a straitjacket. It prevented the Federal Reserve from lowering interest rates to ease the crisis. It forced contractionary policies precisely when the economy needed expansion. It transmitted the American collapse to every country whose currency was tied to gold, and almost no one saw it coming. Not the Federal Reserve governors who'd raised rates in 1928 to cool speculation. Not the Treasury officials, who defended the gold standard as sacred. Not the bankers who'd built their fortunes on the assumption that American finance was too sophisticated to fail. They'd convinced themselves the system was unbreakable. They were about to discover it was designed to shatter. Wall Street's culture of denial. By the summer of 1929, warning signs were everywhere. Stock valuations had detached from reality. RCA, which had never paid a dividend, was trading at a price-to-earnings ratio that assumed perpetual exponential growth. Several economists, including Roger Babson and Paul Warburg, issued public warnings. Babson predicted a crash. Warburg warned that speculation had reached dangerous levels. They were ignored. Worse, they were mocked. After Babson's warning, the market briefly dipped, then roared back. Newspapers called it the Babson break, a joke. Proof that the pessimists didn't understand the new era. Charles Mitchell, president of National City Bank, gave a speech assuring Americans that the market was on solid foundations. Irving Fisher, the most famous economist in America, declared that stock prices had reached a permanently high plateau. These weren't con men. They believed it. They'd built careers on the assumption that modern American capitalism had transcended history, that scientific management and technological progress had created a machine that couldn't fail. They were about to discover how wrong they were. 1 p.m. Credit evaporates. Back on the trading floor, the situation was deteriorating. Margin calls were coming in waves now, not just from small retail investors, from major institutions, from brokerage houses, from banks. At 1:15 p.m., a rumor began circulating. Several major banks had stopped extending credit entirely. The rumor was true. National City Bank, Chase National, Guarantee Trust, the pillars of American finance, were refusing new loans. Worse, they were calling in existing loans. This was unprecedented. Call loans were the lubricant of the entire system. Brokers borrowed from banks on a daily basis to finance margin accounts. The loans were called call loans because they could be called, demanded back, at any time. But in practice, they were always rolled over, day after day, year after year, until October 24th, 1929. That afternoon, the banks called their loans. Every broker on Wall Street suddenly needed cash. Immediately. The only way to get cash was to sell stocks. But everyone was trying to sell, and no one was buying. Prices collapsed. 2:30 p.m., the domino effect. At Harris, Winthrop and Company, a mid-sized brokerage on Pine Street, the scene had descended into chaos that would have been unimaginable 24 hours earlier. Senior partner William Harris stood in the center of the trading floor, surrounded by a cacophony of ringing phones, shouting clerks, and the relentless chatter of the ticker-tape machine that was now running 2 hours behind reality. Every phone call was a client demanding to know what was happening. Every conversation ended the same way, with Harris explaining that their account had been liquidated, their life savings were gone, and in some cases, they now owed the brokerage thousands of dollars. One call stood out. A doctor from Philadelphia, Dr. Robert Chen. He'd invested his entire savings, $40,000, in utility stocks. Conservative investments, Harris had assured him. Steady dividends, safe as government bonds. But Dr. Chen hadn't just invested his savings. He'd borrowed another $40,000 on margin, convinced by Harris that utilities were a can't-lose proposition. When utility stocks dropped 15% that morning, the margin mathematics became brutal. The $80,000 position was now worth $68,000. The borrowed $40,000 was still owed. Dr. Chen's $40,000 in equity had evaporated, and he now owed the brokerage $12,000 he didn't have. "I trusted you," the doctor said over the phone, his voice breaking in a way that Harris would remember for the rest of his life. "You looked me in the eye. You told me it was safe. You said utilities never crash. I have 3 children. I was going to send them to college. You told me it was safe." Harris had no answer, because he'd told the same lie to himself. His own money was in the market. His house in Westchester was mortgaged to buy stocks. His children's education fund was entirely in RCA and General Motors. His wife's jewelry, sold last month to double down on what he was certain was a temporary dip. That money was gone too. It was all gone. Harris stood there, phone receiver in hand, and felt something crack inside himself. Not just his portfolio, his entire understanding of how the world worked. He'd spent 15 years mastering the markets, reading balance sheets, analyzing price-to-earnings ratios, building a reputation as a prudent, conservative broker who protected his clients' money. And he'd been completely, utterly wrong about everything. Across the street, at the offices of Goldman Sachs, a different kind of catastrophe was unfolding. Junior partners were carrying boxes out of the building, not because they were being fired, but because the firm itself was on the edge of insolvency. Goldman had created something called investment trusts, essentially early mutual funds, and sold them to the public at massively inflated prices. The Goldman Sachs Trading Corporation, launched in 1928, had used investor money to buy stocks on margin, then used those stocks as collateral to borrow more money to buy more stocks. It was leverage on top of leverage on top of leverage. When the market crashed, the trusts collapsed like a house of cards built on a fault line. The Trading Corporation, which had traded at 326 per share, was now at 1.75. Millions of dollars in investor wealth. Gone. And Goldman's own capital, which was entangled in the trusts, was evaporating in real time. By 3 p.m., 3 brokerage houses had closed their doors permanently. By 4 p.m., 12 more were on the brink. And the ticker tape kept chattering, printing prices from 2 hours ago, as if the past could somehow save them from the present. 3:45 p.m. Silence in the boardrooms. Back at 23 Wall Street, the bankers reconvened. They'd made a decision earlier, to pool resources and buy stocks, to signal confidence, to stop the panic. It had failed. They'd deployed $240 million, an astronomical sum, buying blue-chip stocks at 1:30 p.m. By 3:30 p.m., those stocks had lost another 10%. The bankers' intervention hadn't just failed. It had revealed the scale of the problem. If $240 million couldn't stabilize the market, nothing could. Thomas Lamont drafted a statement for the press. It would become infamous. There has been a little distress selling on the stock exchange. The situation is fundamentally sound. Even as he wrote it, he knew it was a lie. In the corner of the room, Albert Wiggin stared at a ledger. He'd spent the last month secretly selling short his own bank's stock, betting it would fall. He'd made millions. But sitting in that room, watching the entire financial system unravel, even Wiggin understood. He hadn't outsmarted the system. He'd just been the first rat off the ship. 4:00 p.m., the exact moment the myth died. The closing bell rang at 4 p.m. The Dow Jones Industrial Average had fallen 11%. Volume, 12.9 million shares. A record. The ticker tape didn't finish printing the day's trades until 7:08 p.m. But the numbers weren't the story. The story was what happened in the minds of the men who'd built the Roaring Twenties. That evening, in private clubs and penthouses and quiet offices across Manhattan, a generation of financiers confronted an unbearable truth. The prosperity they'd presided over hadn't been real. It had been leverage. Every factory, every automobile, every radio, every gleaming skyscraper, it was all real. The innovation was real. But the wealth, the fortunes made in the stock market, the belief that America had discovered a permanent prosperity machine, that had been a dummy illusion, a mass delusion built on borrowed money, sustained by rising prices, and believed by everyone from J.P. Morgan Jr. to the shoeshine boy on the corner. And on October 24th, 1929, the illusion shattered, not because of a conspiracy. not because of sabotage, because the system had been designed to fail. October 25th. The morning after. Friday morning felt like waking up in a foreign country. The newspapers tried to maintain calm. Headlines read, "Worst over, say bankers," and market rallies on heavy buying. But on the ground, reality told a different story. Banks opened to crowds. Not crowds of investors eager to buy the dip, crowds of depositors demanding their money. Bank runs begin. The connection between the stock market crash and bank failures wasn't obvious to most Americans. Stocks go up, stocks go down. That's Wall Street. But your savings account? That was supposed to be safe, except it wasn't. Because banks in the 1920s didn't just hold deposits. They invested them in stocks, in real estate, in margin loans. When the market crashed, banks didn't just lose some money, they lost depositors' money. At the Bank of United States, an intentionally misleading name, it was a private bank with no government connection, lines formed at 5 a.m. By 9 a.m., the queue stretched 4 blocks. Inside, tellers counted out cash with shaking hands. The vault was running low. By noon, the bank closed its doors. 400,000 depositors, mostly Jewish immigrants from the Lower East Side, lost their savings. It was the largest bank failure in American history up to that point. It wouldn't be the last. Middle America discovers the lie in Akron, Ohio. A tire factory worker named Frank Novak had invested 3 years of savings in General Electric stock. His broker had assured him it was safe. Blue chip, industrial company, pays dividends, on margin, of course. When the margin call came, Novak didn't understand. He'd bought the stock at $3.20. It was now at $200. He hadn't sold. How could he owe money? His broker tried to explain. But the concepts, leverage, collateral, liquidation, they were foreign. Novak worked with his hands. He built tires. He'd trusted the system to make sense. It didn't make sense. He lost everything. In Chicago, a schoolteacher named Margaret Brennan had saved for 15 years. She'd invested in a mutual fund, an investment trust, sold to her by a reputable bank. The fund was supposed to be diversified, safe. The fund was leveraged 3-to-1. When it collapsed, Brennan didn't just lose her savings. The fund's creditors demanded she pay her share of its debts. She owed $7,000. Her annual salary was $1,200. Hoover's denial president Herbert Hoover held a press conference on October 25th. The fundamental business of the country is on a sound and prosperous basis. It was the same lie Thomas Lamont had told. The same lie the newspapers were printing. The same lie everyone wanted to believe. But the numbers didn't lie. Industrial production was falling. Unemployment was rising. Credit was frozen. By November, factories were laying off workers. By December, bread lines were forming in major cities. By spring, shantytowns, Hoovervilles, appeared in parks and vacant lots across America. The Great Depression had begun. But Hoover kept insisting the fundamentals were sound, just like the Nazis would insist, a decade later, that Germany could defeat American industrial capacity. Belief systems are powerful, even when reality is screaming the opposite. The psychological collapse. On November the 1st, 8 days after Black Thursday, a businessman named James Reardon shot himself in his Manhattan apartment. He left a note, "I cannot face what I have lost." He was the first of many. In the months that followed, newspapers stopped reporting suicides. There were too many. It was demoralizing. Bad for public confidence. Bad for the fragile psychology of a nation trying to convince itself that recovery was just around the corner. But the stories spread anyway. Whispered in speakeasies, shared in bread lines, passed along in the unemployment offices that were springing up in every city. Men jumping from office buildings on Wall Street. The myth of stockbrokers leaping from windows became so pervasive that it entered American folklore, though the actual numbers were likely exaggerated. but the symbolism was perfect. Men who'd reached the heights of American capitalism, quite literally falling. Families found dead in their homes, gas ovens turned on, windows sealed with towels, murder-suicides where fathers killed their children rather than watch them starve. A note left by a Chicago father read, "I invested in America. America has nothing left for us." In Detroit, a middle-aged accountant named George Watts walked into his office one Monday morning, organized all his files alphabetically, then hanged himself in the supply closet. His secretary found him with a balance sheet pinned to his chest. At the bottom, he'd written in red ink, $327,000 lost, nothing left. The psychological toll of the crash wasn't just about money, though the money mattered desperately to people who'd lost everything. It was about something deeper, something that cut to the core of American identity. These were people who'd been taught, by newspapers, by radio programs, by business leaders, by government officials, by their own brokers, that America was different, that the old European cycles of boom and bust were obsolete, that hard work and smart investing guaranteed success, that the system was fair, modern, scientific, that if you played by the rules, studied the market, invested wisely, you would be rewarded. Discovering it was a lie, that the deck had been stacked, that the prosperity was borrowed, that the people in charge didn't understand the system any better than you did, that your life savings could be obliterated, not through any fault of your own, but through the collapse of a system you were told was unbreakable. It was soul-destroying. The American dream hadn't just failed to deliver, it had been revealed as a con, a Ponzi scheme, a mass delusion that everyone from J.P. Morgan to the shoeshine boy had believed, because the alternative, that it was all built on nothing, was too terrible to contemplate, and now they had no choice but to contemplate it, every day, in breadlines, in shuttered factories, in foreclosed homes, in the eyes of their children, who asked why there was no food, no heat, no hope. The cascade begins, winter 1930. The stock market crash didn't cause the Great Depression directly. That's what economists would argue for decades. The crash was just a symptom, they'd say, a warning sign. The real problems ran deeper. But tell that to the depositors lined up outside the Bank of United States on a freezing December morning in 1930. Tell that to the farmers in Iowa watching their land get auctioned off because crop prices had collapsed and they couldn't make mortgage payments. Tell that to the factory workers in Detroit who showed up to their shifts and found the gates locked, the factory closed. No explanation, no final paycheck. The crash revealed weaknesses that had always been there. But revelation isn't passive, it's a catalyst. And once the cascade started, nothing could stop it. By 1930, the dominoes were falling in slow motion, but with inexorable force. The banking death spiral. Between 1930 and 1933, 9,000 American banks failed. 9,000. Think about that number. At the start of 1930, there were approximately 25,000 banks in America. By 1933, more than a third had vanished. Not merged, not acquired. Vanished. Their assets seized, their depositors wiped out, their buildings boarded up like crime scenes. The mechanism was brutally simple. When a bank failed, deposits vanished instantly. Mrs. Eleanor Thompson of Topeka, Kansas, who'd saved $3,200 over 15 years working as a seamstress, woke up one morning to find her bank had closed. The sign on the door said, "Temporarily suspended operations." But everyone knew what that meant. Her money was gone, not reduced, not frozen, gone. When deposits vanished, people couldn't pay mortgages. The mortgage on Mrs. Thompson's small house, $85 a month, became impossible. She begged the bank for an extension. They foreclosed within 60 days. The bank sold her house at auction for $400, a fraction of its value, just to recover something. When mortgages defaulted, more banks failed, because banks didn't just hold mortgages as pieces of paper. They'd bundled them, used them as collateral for other loans, built entire portfolios assuming real estate values would remain stable or rise. When foreclosures flooded the market, property values collapsed. A house worth $5,000 in 1929 sold for $1,200 in 1932. Banks holding those mortgages as assets discovered their balance sheets were fiction. The feedback loop was identical to the margin call spiral that had destroyed the stock market, just slower and larger and more devastating to ordinary people who'd never bought a stock in their lives. The human face of collapse. In Nashville, Tennessee, a hardware store owner named Frank Morrison had kept his money in Caldwell and Company, the largest financial institution in the South. Caldwell wasn't some fly-by-night operation. It was respected, solid. It financed everything from municipal bonds to insurance companies across 6 states. In November 1930, Caldwell collapsed. Morrison lost $12,000, his entire life savings. He was 58 years old, too old to start over, too young to give up. He tried to keep the hardware store open, but his suppliers demanded cash payments. He couldn't get credit anywhere. No bank would touch him. By March 1931, he'd sold the store for pennies on the dollar. His wife took in laundry. His son, who'd been studying engineering at Vanderbilt, dropped out and rode the rails looking for work. This story repeated itself millions of times across America. The bank failures destroyed more than money. They destroyed the fundamental infrastructure of trust that makes a modern economy function. If you can't trust banks to hold your deposits, you stuff cash in your mattress. If everyone stuffs cash in their mattresses, banks have no deposits to lend. If banks can't lend, businesses can't borrow to meet payroll or buy inventory. If businesses can't operate, they lay off workers. If workers lose their jobs, they can't pay mortgages or buy goods. If they can't buy goods, more businesses fail. The spiral continues until the entire system seizes up like an engine without oil. By 1933, industrial production had fallen 46% from its 1929 peak. 1 in 4 American workers was unemployed. Those who still had jobs saw their wages cut 40% or more. The international gold standard catastrophe. Remember the gold standard, the system that was supposed to ensure stability, the monetary anchor that was meant to prevent exactly this kind of chaos? It transmitted the American crisis worldwide, like a virus spreading through a circulatory system. The mechanism was inexorable. When U.S. banks failed, they called in loans from European institutions, not because they were cruel, but because they had to. When depositors demanded their money back, banks needed liquid assets. That meant calling in foreign loans immediately. European banks, already weakened by World War I debts and reparation payments, couldn't absorb the shock. In May 1931, Austria's largest bank, Credit Anstalt, collapsed. The Austrian government tried to bail it out. They failed. The bank's failure triggered runs on banks across Central Europe. When European banks collapsed, they called in loans from South America and Asia. Argentina, which had borrowed heavily to finance infrastructure, suddenly faced demands for immediate repayment in gold. The Argentine government couldn't comply. Their currency collapsed. Trade stopped. The economy imploded. The same pattern repeated in Brazil, in Chile, in Australia, in Japan. The entire global financial system was interconnected through gold-backed currencies. Every major currency, the dollar, the pound, the franc, the mark, was theoretically convertible to gold at fixed rates. When one link in the chain broke, the stress transmitted instantly to every other link. It was a feature, not a bug. The gold standard was designed to maintain fixed exchange rates, to prevent competitive devaluations, to ensure sound money. What it actually ensured was synchronized global collapse. By 1931, Britain, the architect of the modern gold standard, the nation that had based its entire imperial economy on the pound's convertibility to gold, abandoned the system. On September 21, 1931, Britain suspended gold convertibility. The pound was allowed to float. It was an admission of defeat, an acknowledgement that the system couldn't handle the deflationary spiral that had been unleashed. By 1933, America followed. Roosevelt suspended gold convertibility and devalued the dollar. The gold standard, which had been treated as sacred economic doctrine for generations, was revealed as a straitjacket that had amplified the crisis rather than contained it. But the damage was done. The years between 1929 and 1933 had destroyed decades of wealth accumulation, and the consequences would shape the rest of the century. Wall Street's regret. Too late. In the years that followed, some of the men who'd orchestrated the boom tried to make sense of what had happened. Their reckonings came too late to matter, but they're worth examining because they reveal how even sophisticated insiders fundamentally misunderstood the system they'd created. Thomas Lamont, J.P. Morgan's right hand, the man who'd drafted the fundamentally sound statement on Black Thursday, wrote in his private diary years later, "We thought we understood the machinery. We measured the gears, calculated the ratios, monitored the flows. We didn't understand that we'd built a machine that could only function under perfect conditions. The moment conditions changed, the machine didn't slow down. It devoured itself." It was a remarkable admission from a man who'd spent his career projecting absolute confidence in the system. Charles Mitchell, the president of National City Bank, who'd assured America that speculation was under control, was prosecuted for tax evasion in 1933. He was acquitted on a technicality, but his reputation was destroyed. He'd become a symbol of the reckless optimism that had led America off a cliff. He lived another 22 years, but never returned to banking. In private letters, he wrote that he'd believed his own lies, that he'd convinced himself the new era was real because the alternative, that he was presiding over a bubble, was too painful to contemplate. But perhaps the most tragic figure was Irving Fisher. Fisher was the most famous economist in America, a Yale professor, the author of mathematical models that were supposed to predict market behavior with scientific precision. On October 17, 1929, 1 week before Black Thursday, he declared that stock prices had reached a permanently high plateau. It became the most infamous prediction in economic history. Fisher lost his entire fortune in the crash. Everything. He was forced to sell his house. His family had to move into a smaller home provided by Yale out of pity. He spent the rest of his life trying to understand what had gone wrong. His conclusion, published in papers and books that few people read because everyone wanted to forget: debt deflation. When asset prices fall, debt becomes more expensive in real terms. A mortgage that seemed manageable when your house was worth $10,000 becomes crushing when the house is worth $3,000, but you still owe $7,000. People respond by cutting spending to pay down debt. Reduced spending causes prices to fall further. Deflation. More deflation makes existing debt even more burdensome in real terms. More debt burden. More spending cuts. A spiral that feeds on itself. It was the same mechanism as margin calls, just applied to the entire economy. Fisher had discovered it too late. His mathematical models had been elegant, sophisticated, impressive, but they'd been built on a fatal assumption that the system was stable, that shocks would be absorbed and equilibrium restored. They hadn't accounted for the possibility that the system itself was the shock. The global consequences, democracy in retreat. The Great Depression didn't just impoverish millions. It destroyed faith in democracy, in capitalism, in the liberal order that had emerged from World War I. In Germany, unemployment reached 30% by 1932. 6 million Germans out of work. The Weimar Republic, already fragile, already despised by nationalists as a humiliation imposed by the victorious Allies, couldn't survive the economic catastrophe. People stood in bread lines that stretched for blocks. Children went to school hungry. Middle-class families who thought themselves secure found themselves begging on streets. The Nazis offered a simple explanation. The depression was caused by international Jewish bankers, by the Treaty of Versailles, by the weakness of democratic government. They offered a simple solution: strong leadership, national unity, economic autarky, rearmament. In January 1933, Hitler became Chancellor. By March, the Reichstag had granted him dictatorial powers. The most destructive regime in human history came to power because democracy had failed to provide economic security. In Italy, Mussolini consolidated power, using the depression to crush opposition and complete his fascist revolution. In Japan, militarists took control of the government, arguing that democratic weakness and dependence on international trade had left Japan vulnerable. The solution, they claimed, was military expansion, conquest of resource-rich territories, creation of an autarkic empire. In Spain, economic collapse contributed to the outbreak of civil war in 1936. Across Latin America, democracies fell and were replaced by military dictatorships. Even in the United States, faith in capitalism wavered. Socialist and communist parties gained membership. Huey Long, the populist demagogue, promised to redistribute wealth and drew enormous crowds. Father Coughlin, the radio priest, preached a blend of populism and anti-Semitism to millions of listeners. For a moment, it seemed possible that American democracy itself might not survive. The pattern was global and unmistakable. When capitalism failed, when democratic governments couldn't provide economic security, people turned to authoritarianism. World War II didn't start in 1939 when Germany invaded Poland. It started in 1929 when the global financial system revealed it was built on nothing. The Depression created the conditions, the desperation, the nationalism, the militarism, the rage that made the war inevitable. 50 million people would die because Wall Street believed its own lies.